Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me on the show today is a new guest to the show, Trader Stef from TraderStef.com. She began investing in precious metals in 1999. How are you today, Stef?
Hey, I'm good, Tom. Thanks for having me. How are you?
I'm great. Great to have you. Before the call, we were speaking about the Italian strain lineage of the COVID virus. And you were mentioning to me something interesting about that. So maybe give our listeners a bit more about, fill them in on what you're seeing there.
Yeah, sure. In a March interview, I had mentioned that unfortunately we had all been infected by the virus, not literally, but rather everything that we were doing it or going to do on a daily basis was going to be impacted, and in the financial markets as well. And, the question is it going to force the Fed's hand? And the coronavirus and the Fed could trump the stock markets and the gold market, with the Fed being forced to act and the global financial system grinding to a halt. And in hindsight, that's exactly what happened. But I think there's just so much information out there as well as misinformation. And sometimes it can be semantically kind of tricky to figure out what's going on. So I just wanted to get something out there so everyone knows there's talks about mutations and where it came from or where it's going or what's happening in this country or that country. I just want to cut to the chase and make the point that the mutation that came from Wuhan that moved on to Italy had mutated in Italy and then infected Europe. And then that jumped the shark through jet travel, did the East Coast of the United States, South America, Northern Africa, et cetera, as the United States was focused on the West Coast, on travelers from Wuhan, we were being invaded in the back door. And to this day, you're not really getting that perspective in the mainstream media or, quite frankly, even the majority of alternative media. So with the Italian strain, it was much more virulent. And, Italy was the first Western nation that really got hit hard, and we could trust the information that was coming out, and we knew that their medical system was at par with what we had in the United States. So we were kind of late to the game, but we did know about the gene sequence. We did know that it was not a bioweapon, even if something was being done to it through splicing, that leaves footprints. You could tell. So now that this thing has dominated the globe, it has seeded everywhere, everyone's infected, and you can go look at the GSAID site, and you can actually watch how it has spread across the world, the Italian strain, and then it takes over all the other strains that may have been around, with regards to coronaviruses, and now it's got a lineage that are not outright serious mutations. It's just kind of like a flowchart in corporate, if you imagine that. But the fear is that this Italian strain could really make things difficult in the fall if it does mutate to another level. And that is the one that really, and not a new one that will come out. And we would again be behind the curve because it can take weeks for information, gene sequences to be done to really understand what was happening. But this is a herald wave.
Stef, as we're talking about, let's say, alternative ways of looking at the information that everything is provided and misinformation, let's talk a little bit about real versus nominal interest rates. So the first chart we have here, and you've been very gracious to provide us with a lot of charts for this interview. I'll just remind listeners that they'll all be available on the YouTube video. So, Stef, let's talk a little bit about real interest rates versus nominal interest rates and the misinformation and the mismeasurement of how the Fed is looking at quote-unquote interest rates.
Sure. The chart is the 10-year Treasury note, and you can see it goes all the way back to 1963. And it's not a coincidence that since the early 80s, where inflation had really peaked after the 1970s debacle, that the 10-year note has been frankly collapsing. Even a year or so ago, everyone was concerned about it breaching 3%. There was kind of like a double channel there going on. That never happened. Now we're down to 0.5%. But, just put this in perspective, over the last couple months, the Fed has made a few comments, such as they don't expect to lift its benchmark interest rate until 2023. They have no interest whatsoever on raising rates. And Powell himself said, we're not even thinking about raising rates, for at least until 2023. So if we look at that, the 10-year note is like the benchmark as far as interest rates. So that's why I'm using it. And what you have to do is think about what inflation is. And the Fed is even thinking about eliminating inflation, the 2% benchmark, and let it run higher, despite the fact we're actually in deflation now. And I think it's running at about 0.5% when you look at the official CPI. But the issue is, as you mentioned, it's negative interest rates. We're already there. Everyone's talking about the Fed policy rate or what the CPI is. But if you go back and look at the 1980s base case and how it was formulated then, and then the other way it was formulated through the 90s, inflation is running at a much hotter pace than, the headlines that you're seeing of roughly 0.5%. We're looking at, depending on which one you're looking at, we're running anywhere 5 to 7% inflation as of this month. So if you take the rate of inflation and you subtract it from the interest rate, no matter what that interest rate is referring to, but we're just talking about the 10-year note, we're actually in negative territory. And it's been that way, actually worse than that, over in Europe. I'm not really sure about their inflation rate, but in Europe, and the European Central Bank, they've been using negative interest rate policy, not even real negative interest rates, since 2014. So their pensions are really beginning to suffer now, just as in the U.S. we have a major problem with pension systems. So everyone's being hurt by this. And now that we're in a deflationary environment, what are you going to do? And everyone thinks, right, we are having inflation to some degree. But you have to be very specific about what kind of inflation you're talking about. The stock market went up. Yeah, real estate prices went up. Prices are generally higher in the grocery store than they were 5 to 10 years ago. But when you really boil down to what's going on, the old formula really included like energy, the price of oil, which it doesn't now. So there's a lot of variables when you're talking about inflation. But I think that brings in something very important about the next topic, and that's the velocity of money.
Before we get to the velocity of money, why don't we just touch on definitions of ZIRP and NIRP? They're not something, if you just heard them, you'd think maybe it's like a children's cartoon character or like a comic book character. But explain to us a little bit about how they fit into this inflation picture.
Well, NIRP represents negative interest rate policy. And the Fed doesn't want to go policy-wise, officially negative. But as I just explained, we're already there. We're in real negative interest rate territory. And ZIRP represents zero interest rate policy, which is where we're at now. Their policy, official policy rate, I think, is somewhere between 0.25 and 0.5%. So we are at zero policy. So all that plays in to, when was the last time you got something better than 0.5%, for instance, at a savings account at a bank, or even on a short-term or a certificate of deposit for a year? You're just not getting paid interest on your capital. So it destroys everything. It really limits to what you can invest in and where you can risk your capital.
Absolutely. And as we're speaking about certificates of deposit and stuff, one of the things we spoke about before the call was a definition of M1, M2, and MZM money supply. So could you just quickly define those as well for us, please? Absolutely.
So there are several different forms of velocity of money. I like calling it velocity of paper. That's what we're talking about. But there's M1, M2. There was an M3, but that's gone now, so we're not even going to mention it. And then there's MZM. M1 is like the narrowest component. And it's the money supply of currency in circulation, and that includes notes and coins, travelers' checks that are non-bank issuers, demand deposits, and checkable deposits. And then M2 includes all of that, but it also includes CD certificate of deposits that are less than 100,000 and money market deposits for individuals. Now, when you take MZM, that's the broadest of everything. And that is about the supply of financial assets redeemable at par, on demand. So that includes notes and coins in circulations, traveler's check from non-bank issuers, demand deposits, other checkable deposits, savings deposits, and all money market funds. So MZM really gives you a handle on how financial assets are changing hands in the economy. And that's what the velocity of money is. It's how fast a dollar, for instance, is exchanging hands out there in the real economy. And if that's not happening, you're not going to get a big uptick in inflation. So when you look at the velocity of money chart, and if you look at the MZM, take note of what happened around 1980. You know, that time frame continues to come up in a lot of discussions about economics and what's going on. But it's been collapsing. And if I'm not mistaken, I couldn't find a chart readily that would correctly define what it was, say, during the Great Depression, but I'm almost certain we're below that now as well. But even Jim Rickards had mentioned recently, give Jim a plug here, on Twitter, he said, for Austrians, monetarists, and neo-Keynesians who still think money printing causes inflation, it doesn't. Here's what you're missing. The velocity of money has collapsed, and the Fed can't control velocity. You know, it's really simple. So exactly why the Fed says, hey, we can print out all the money that we want, but we're not going to do anything for the economy if Capitol Hill doesn't use that policy to institute fiscal policies that can make a difference. The problem is you get all that money sloshing around and people really start spending it, you can get a high rate of inflation. And now the Fed wants to ignore it on top of everything else that's going on. So we've got quite a confluence of events that are taking place on so many levels. It's beyond black swan. It's unprecedented.
So as we're talking, like you're saying, to take into consideration this black swan, we've seen the velocity of money just collapse because nobody's out spending and they're being much more frugal and staying at home a lot more. But as our listeners know, this creates wonderful setup for gold and silver. So why don't we move into a couple of the gold and silver charts here?
Oh, absolutely. One thing to mention is, well, what's that dollar doing? There's a lot of talk about the dollar. Most recently, there's been an interesting disconnect between what was traditionally, you know, as the dollar is going down, gold is going up. Well, you know, that's not that that doesn't happen. But for me, I noticed on the charts over the past several years, there have been episodes where they were trending together or trending down together, as well as diverging in one direction or another, rather than being kind of stable and being, you know, opposite of each other, what was going on. But the U.S. dollar monthly chart, you know, we have a level right around 91, and I'm referring to Fibonacci levels, and I'll talk more about those when we get into the gold chart. Then I would be concerned with the dollar falling further, but looking at the momentum and the studies on the chart that I've provided, we're probably going lower, and we're probably going to go down there into the low 90s and upper 80s. And then, you know, after that, we're looking at the mid 80s and the lower 80s. So time will tell. As far as gold is concerned, you know, I mentioned a lot, I think a lot of folks don't pay attention to seasonality. But, you know, this year, when you look at the gold chart and say a 20-year average of what the gold futures price does throughout a year, you know, we've been spot on with the exception of the anomaly that occurred in March because of the peak virus fear. We are now in the seasonal pattern where we tend to trend up until at least the end of the year. Now, it will be choppy, but we are in an uptrend. Now, looking at the gold chart, I'm going to jump around on the time frames, but if we take a look at that daily chart, it was published on the 26th. It gives you a nice visual of what happened since last summer, and it breaks down all the chart patterns throughout that whole process, all the Fibonacci levels, all the lateral resistance levels that were drawn back to 2011 through 2015. And we tapped that all-time high just after 10 o'clock at night on the 26th. That was quite a moment to be part of a raging gold bull market twice in one lifetime. Doesn't happen very often. But if we jump over to the gold spot monthly, I wanted to separate a couple terms and bring some things to light where there's different kinds of bull markets. You know, we have a primary bull and a secular bull. And primary bull are the accumulation phase. It's when smart money is adding positions. There may be some chop and volatility, but most folks at that point are pretty sure that a bottom has been put in. So if you notice back there in late 1999, there started to be some accumulation. And then when we took out a high around $350, that was a secular bull run all the way up to the high in 2011, September. We broke down, we had a bear market, we put in the low of 1046, December 2014. In hindsight, shortly thereafter, it became clear that that was probably the low in gold, and then that is where the next primary bull began. And it wasn't going to become another secular bull, or at least reestablish the secular bull trend, until we took out the all-time high. But even for me, there was a level that was even more important than the all-time high, and that was 1,380. And that is a Fibonacci level. When you drew down from the highs up in 2011 down to the lows in 2015, that 1380 level was not breached and or at least closed above since 2013. So we're looking at 7 years. And then from 2015, that was an accumulation phase. And then we breached that level, and you can see how that channel has formed on the monthly, and we're going straight up. Now, once you're in blue skies, you don't know where you're going. You have no history to reference as far as laterals and resistances. So really, one of the only tools you have is Fibonacci, because you can snap the lines. And I've got these levels, and you can see they're right on that chart. 2050, I want to give round numbers, 2050, 2130, 2200, 2250, 2350, 2450. Those are the levels that we can expect, not necessarily in the near future, but going forward as we rage through this new secular bull trend. And notice down on the bottom, I got some other studies there. You've got the DMI ADX. That is a momentum and trend indicator where they're combined, really important. And then the Stoke RSI, but take a note of that arrow down there in the DMI ADX. There's a name for that. I coined it. It's called an alligator tongue, because if you look at the profile with an alligator with the tongue out, it kind of looks like that. But when you read the book by Charles Schwab, ADX Excellence, Power Trend Strategies, what this is all about, that's really a powerful setup right there. And you can see how that played out, say back in 1990 going up to 2011. And we're just kind of beginning right now. And we have so much more volume. The Stoke RSI is overbought on the monthly, but it can stay pasted up there for some time. You know, bulls can run a lot further and a lot quicker before it throws you off than some people can expect. And the downside in a bear is the same way. And if you look at the momentum and the money flow, we're up to where we were back in 2011. And then the last chart, let's get into more prescient time for the weekly. If I'm looking at the live chart right now, this morning, the gold price is trading at 2060. So looking at that weekly chart, we're kind of zoomed in from the 2015 low. Take note of that DMI ADX. We're not going to be in overbought on that until that ADX which is now at 52 roughly, gets up around 60s and the 70s. If you look at the Stoke, it's plastered. That's also overbought. The money flow and the momentum are also getting up into that territory. And another thing that stands out is the bear trap that occurred in the channel back in March. That was a good opportunity if you took advantage of it. So now that we're up into that blue sky territory, you got to take a look at those Fibonacci extensions and pay attention to those, because you don't want things to go straight up. That's never good in the market. You need to have some time for consolidation and breathing. I understand everyone being excited about the price moving, but take advantage of any dips that come along that consolidate and practice good risk management here. And what you want is low risk and high reward. Don't get crazy and be buying at peaks. What you want to do is take profit on strength and buy on weakness.
So, Stef, one of the things that jumps out to me here that I wanted to ask you about, and you kind of touched on it, when we're looking at all these different indicators, and obviously with this run up that we have seen, do these markets show us that things are overbought right now and that there is a correction possibly coming?
Well, yeah, things are actually overbought, but when you're looking at different time frames, we could even drill down into shorter time frames. Some are more overbought than others, and that shifts. But now that we're in a secular bull, things can get a little nutty. You know, things can run a lot further and faster than what you may imagine that they would. I've even seen some comparisons. Some folks think that the spike that they're seeing in the charts is much more steep than it was, say, back anywhere between 2002 and 3 up to 2011. Well, that's actually not the case, because if you pull up a logarithmic chart, which is based on percentage gain, it's not even close. And if you didn't live it through that bull market, you really wouldn't get that either. So yes, we're overbought, but we can stay there. But the time frames vary with regards to the indicators. And right now, on a daily, if I pull up the live chart, at least on my screen, let's see what I'm looking at. Yeah, the daily, when I'm looking at the ADX on the DMI, that's the black line. That's the alligator's tongue, actually. We're at 70 on the daily. I've never really seen it go beyond. Well, I've seen it in the 90s once before. Not even during the 2011 peak was it up in the 90s. So, you know, we're in pretty good overbought territory. But once again, I'm sorry to be repeating myself, but given the circumstances that we're in right now with the economy and the pandemic, and there's just so many issues on the table right now, anything is possible, but that doesn't mean you just sit back and be complacent. You have to be active with your investment.
Absolutely. So let's move on to the silver weekly chart and tell us a little bit about the indications that you have put on that one.
Silver, the poor man's gold. And that's what's great about it. It's a much lower price point, which means you can invest more capital on top of taking advantage of the greater percentage gain. Because as I was mentioning with the logarithmic chart, you're looking at the percent gain. And the price of gold is up there so high, it takes a lot more of a rise just to get that return on your capital. You know, to get 100% gain on gold, it needs to double from here if you bought today. But with silver, we only got to get to the all-time high. We haven't even gotten there yet. So that's what's great about silver on many levels. I mean, it was a buy over the past several years for various reasons. But if we look at that silver spot monthly chart, once again, I'm going to focus on the Fibonacci. And I beat this like a dead horse for several years on that 2149. And just stare at that for a minute and notice that there was a high put in 2008, just as the great financial crisis was getting hot. And then it corrected, just like gold did. But both of them outperformed the Dow, by the way, when all was said and done. But silver, when it took out that level again, that was the beginning of the rocket shot to its all-time high in 2011. Now, remember, it put in its high 6 months before gold put in its high, and it began collapsing a lot quicker long before gold made its all-time high. So when we got the first dead cat bounce off some of the initial 2013 lows, it never took that out, or it never at least closed above it. It had a real hard time there. And then again, even during the run in 2015 into early 2016, it never took it out. It got to 21.13. So right around 2015, 2016, I point out that 21.49, that looks really important no matter what other reasons you want to give or talk about. When we saw that taken out, that was the beginning of the show. Didn't mean that below that level wasn't a good time to, say, be a physical stacker. You should always take advantage of a lower price. But as you can see, and as what has occurred in the market, silver has finally gotten there. Now, I do want to mention a couple things about these silver charts and that overboughtness, because on the daily, which is not shown, the ADX is higher than it was during silver's all-time high in 2011. And the Stochh RSI is also overbought. But look at that volume, and that's all buy volume, by the way, on the monthly chart, when you look down there on the bottom right. And look at those Fibonacci levels that we have to go through to get to the all-time high. And sometimes on those Fibonaccis, they kind of come together. So if you look at the set that's drawn from the low in 2001 up to the 2011 high and how they compare to the 2015 and the 2011 high, you know, the black ones versus the blue ones, sometimes they kind of get squished together. That's known as a confluence. And the tighter they are together, the more so that particular price point will probably be more of a resistance level. There's nothing that's 100% perfect in technical analysis, but it just gives you a roadmap of what you may want to pay attention to when you get there. If there's a spread between them, so if we switch over to the weekly chart, you'll be able to see that. You know, we may get stuck in there. There may be more of a chop in between those two levels. But this morning, for instance, just blew that out of the water. Because overnight, I'm looking at the live silver chart on the daily. We put in a high today of 28. We're talking spot. It's trading right now at 28.03. And put in a high of 28.43. So we've already taken out those two Fibonacci levels because this chart I provided for you last night. So what's next? Well, the next two up there above. So that's going to be around 32 in the high 31 area. That's where we're at. The DMI ADX, that's not really, it's an overbought territory, you could say, but that ADX is not up in the 60s or 70s yet. It just looks really spiky. The Stochh is definitely there. The volume is through the roof. Look at those moving averages. You got that bullish lineup. They're all lining up where they're supposed to be in numerical order. But we need a rest here. It doesn't mean it's going to happen, but the longer you run hot and higher, the harder the fall may be, or the correction, or the length of chop until you move on to another level will have to be. That's just the way it is, no matter what kind of asset you're looking at when you're referring to assets on a chart. So, look, overall, yeah, but just like with gold, we're generally overbought, but we can run further and hotter than anyone may expect. So pay attention to your investment right now. Don't go chasing on strength. If you already have positions, take some profits on really hot strength and then reinvest on the pullback and layer your positions like a ladder so that you're not all in one basket, all in one price level. So I think silver is a good buy here, but it's getting really hot really fast.
Interesting stuff. So just to kind of back out a bit more of a 5,000 foot view, and if and or when we see another crash in the general equities, in your opinion, do you think that gold and silver are going to get drawn down with that just to create liquidity in people's investments?
We'll know when we get there because I hate to say that. It sounds like I'm avoiding to answer the question, but it's true because I've seen both sides of that coin. And, another thing that, for instance, Jim Rickard had mentioned in the past, ICE 9, it's the black swan that bumps into all the other black swans in the pond, for instance, and you get this domino effect. And I think for right now, this domino effect that's taken place, and we haven't even been into the fall season yet and exited the Herald wave, the first wave, in the pandemic to maybe get a feel for what's going on. The Fed, they've made it very clear that what this virus does or does not do is really guiding their monetary policy right now. And they can't do anything about fiscal policy. And Capitol Hill can't even, make a decision on extending the bill to keep things going, to keep people afloat, because if they don't care about the debt, what's the big deal? There's going to be a global currency reset. I'm not saying this is a good thing. Really high gold prices are telling you things are bad. So I can't answer your question. We'll know when we get there. There's a lot going on.
Not a problem. I appreciate an honest answer. Like you say, when we see a higher gold price, it just kind of means either A, major asset inflation, or B, a flight to safety, or a combination of the two, obviously. Stef, why don't you tell us a little bit about the trading program that you have from your website?
Oh, sure. Thank you. I have a trading workshop, if anyone's interested, and I'm not launching it yet. I'm still working on the synopsis. I gave it a little shot on my own there back in the spring, and I realized that I had to tweak it to get it right. So I don't have a launch date right now at this point, but this trading workshop is not a trading room. So if you're looking to follow someone else's trade, or for someone else to make all the decisions for you so you can just be a zombie, this is not for you. But if you want to learn old school basics and keep things really simple and have someone maybe teach you how to fish, this workshop would be for you. And it's not like, okay, I want to go to one workshop and I'm done. I know everything. No, it takes people years to become seasoned in technical analysis. Now, that's not saying that you need to be attending them for years. Everyone's different. You got your own time frame, but don't think this is a one-shot deal. You're going to have to do many sessions just to get the basics down and understand those basics and what's going on in the markets today and how technical analysis actually evolves too in some ways. So I think that would be a great opportunity for some people who would be interested.
And that's going to be available at TraderStef, STEF.com. You're also at TraderStef on Twitter.
Yes.
Perfect.
Follow me on Twitter because if you follow at the website, you'll get the heads up before any analysis comes out. But then I keep a running thread on Twitter, which you may get some real-time updates on a Twitter thread that won't be enough, to produce a whole article or a blog piece.
Excellent, Stef. Well, we really appreciate your time today. Thanks for all the info.
Thanks for having me, Tom. Be safe.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?